Hi everyone and welcome to this webinar today. Today you will hear from Geoff Lucas, Managing Director of the agency group, ASX code AU1, who will provide you with an overview of the company's 2022 full year results. We will have an opportunity to take questions at the end of the presentation, so please submit those in writing using the Q&A button at the bottom of the screen, and we will go through those at the end of the presentation. So as I said, keep all your questions to the end. I'd now like to welcome Geoff Lucas, who will run through this investor deck and will be available to answer questions for you at the end of the presentation. Geoff, over to you.
Thank you very much, David, and thank you everybody for spending some time this morning in letting me present what we think is a very strong and exciting set of financial results. At the conclusion of this morning's webinar, we'll spend a few minutes for those that would like to make some questions. And to submit a question at the end, please just use the chat function in the Zoom webinar. Our presentation this morning is around 15 slides, and we'll spend probably 20 minutes or so running through that, as I said, with some time, a couple of minutes for any questions at the end. As I mentioned at the outset, we're really pleased and excited this morning to release our results showing that we've got an underlying EBITDA for the year of $3.85 million, which is a very, very strong 26% growth on the prior year. Our total revenue for the year is up 24% to $72.7 million. Our gross commission income, which is the aggregate of all of the commissions that are earned and generated by our team of agents, that showed a really strong increase of 27% for the year, up from $80.7 million to $102.5 million for the FY22 year. Equally, the value of the properties that our team have sold increased by 23% to $5.9 billion. The number of properties sold by our team increased by 15%, up to 5,709 properties. Pleasingly, the highest rate of growth across these metrics in the year was the number of agents, with a net increase of 85 agents that have joined our business during the 2022 financial year, where we concluded the year with 393 agents across the country as at 30th of June 2022. This represented a growth rate of 28% on the 2021 agent count of 308 agents. And to me, this is the most important growth metric because it's both a forward-looking indicator and it also confirms our belief that our unique and contemporary direct engagement business model is proving very attractive to agents. I'm actually not aware of any other single business in our industry that's experienced this rate of agent growth. Turning to page 3 of our presentation deck, and this slide shows a number of year-on-year key non-financial metrics that we as a team focus on to measure our progress against our plan. On the far right-hand side is the very significant increase in gross commission income. As I mentioned before, that's a growth of 27% on the prior year. Working backwards right to left, this increase in GCI is off the back of a 21% increase in the value of properties that we've sold during the year. It's very relevant and important to ensure that the increase in value is a result of an increased number of properties sold. And the number of homes that we sold during the financial year increased by 15% over 21, and it's nearly double the number of properties that our team sold in the 2020 financial year. The final columns on the left-hand side show our agent growth across the financial year. Pleasingly, the most recent financial year has the greatest number in any year in the company's history. Over to slide 4, and this intends to give a graphical representation of the regions that our business currently operates in. So since 30th of June 2021, we've entered new geographic markets in Manly in New South Wales, in the Sunshine Coast, Gold Coast and Toowoomba in Queensland, as well as Canberra in the ACT. Following the end of the financial year, the agency entered our 6th state and territory with the acquisition of the Bushby Property Group in July 2022, and that's in Tasmania, in Launceston, where I've got the absolute pleasure of bringing this presentation to you from this morning. I'll discuss a little bit more about that acquisition on the next slide. It's important for me to note that while this demonstrates where we operate, the slide doesn't properly demonstrate the volumes of each region, and a great case in point is over in WA with our Perth-based business. That Perth business was recently awarded the 7th largest office across the entire country by REB. Our main office in the CBD of Perth houses the bulk of our agents, where the team sells between 5 and 6% of the entire Western Australian market volumes from this one premises. And I guess the Perth business is the best example of our business model, which operates on the premise that you no longer need real estate offices on every street corner of every suburb to provide great service, results, and market share. Turning to slide 5, as I mentioned before, this provides some information on the recently acquired Bushby Property Group that settled in July 2022, just after financial year close. The large office in Launceston, in which I'm sitting, has been branded to the agency Team Bushby, and the business consists of 9 sales agents who have sold over 125 million in residential property over the past 12 months. Also acquired were 1,300 properties under management, which brings the total properties under management by the agency above 4,800, which have a combined value of over $3 billion, where our team around the country is collecting approximately $110 million in rent every year for our landlords. Turning now to slide 6, I've stated just before that we have a unique and a contemporary business model. And I guess there's 2 major differences in our business that we believe are continuing to drive agents to join our business. First, unlike the majority of the Australian industry, which is dominated by franchised offices, we contract directly with each of our agents. This removes any interference of separate ownership groups and provides a consistent and steady environment for each of our agents. Secondly, and I've alluded to this before, certainly in Perth, but it's the case across the country, our business operates from large, functionally appropriate hubs, not bricks and mortar offices on every street corner. This reduces the amount of capital deployed and operating expenses in building and maintaining offices where, frankly, customers no longer come. This reduction in expenditure on premises allows us at the agency to reward our agents via higher commission splits, but in a sustainable way that rewards all stakeholders. Just to reiterate, the agency model allows our agents to focus on what they do best, which is selling real estate and providing a high level of service to their customers. They're able to build their own teams underneath them, but they're freed of all of the distractions of managing a property management portfolio or managing office infrastructure, trust accounts, and the like. We've also managed to build very strong strategic partnerships with the industry-leading suppliers to ensure that we've got a fully digital, cloud-based process that ensures the agents can operate from anywhere and enables the agent to quickly and easily get their properties to market. On slide 7, we've highlighted how we as a management team are continuing to reimagine the office in providing a space for agents to dock in between appointments or as a place for tenants or trades to pick up keys. The photo that we've put up on this slide displayed is of our newly opened satellite office in Claremont in the western suburbs of Perth. Now, for those in the eastern seaboard, it's opposite in the west. the higher valued properties along the coastal strip, like Cottesloe, etc., are in the western suburbs. So this office complements our existing large hub in the Perth CBD, and the space currently displays artwork of talented locals, with the inaugural art that we've got in the office showcasing pieces of work from the local Curtin University. This space has been designed and is operating to engage with the community in a way that really builds our brand awareness. I've spoken positively regarding our agent recruitment success, and slide 8 gives some insights into how those additional agents contribute to our profitability. You'll see from the slide that we demonstrate that it takes approximately 3 to 4 months for new agents before they start to contribute to profitability of the business. We've tried to show graphically how recruitment across the period will impact our operating profit. The white section represents months where the agents had not yet joined the business, while the grey boxes represent months prior to the agents contributing profit. The boxes in red are months where the recruited agents are contributing operating profit, which shows that it's predominantly in the months after the financial year end. In the case of a new geographic market, in say a greenfield entry, this can take a little more time, sometimes more closer to 6 months, as the agent starts to build momentum and establishes themselves in the new local market. Depending on the location of the new geographical area, additional operating costs in a new area will only be incurred if we think and believe that there's sufficient scale benefits to ensure that entry into that new market is profitable over the medium term. As an example of this, one of our recent geographic regions is the Sunshine Coast in Queensland. And this consists of 3 separate agent teams, but it has no office while we build appropriate scale in that region. Another example is our Liverpool in Sydney, New South Wales office, business. And that's recently listed the largest residential project in that southwest region with no office. So having covered a high-level overview of our business, how we differentiate, the next few slides will discuss our financial highlights for the period just ended. So over onto slide 10, and what we've done here is to lay out further detail on our financial performance. Off the back of the 24% increase in revenue, and importantly, really importantly, discipline around operating expenses, our cost of doing business has decreased in the period by 430 basis points on the prior year, with our cost of doing business ratio down to 30.3%. The positive jaws of revenue growing faster than costs has led to our EBITDA growth of 26% year on year, delivering the EBITDA of 3.85 million for the year. Turning now to page 11, and this slide provides the detail of the strong growth in some of our key financial metrics. Our revenue has grown strongly for a number of years now, and the business has now reached sufficient scale where we're now delivering solid EBITDA and net cash received from operating activities. In the third group of charts from the left, you'll see that we've generated $4.6 million in operating cash. We've adjusted these numbers to account for the AASB 16 leasing standard, just to give a better representation of the free cash flow from operations that have been generated. In line with the growth of our EBITDA, the cash generation has experienced strong growth during the year, which has ended up building our cash at bank balance to be $8.2 million cash at the end of June 2022. Look, I've mentioned the business reaching scale, and turning over to page 12, we've tried to highlight on this slide how the revenue growth in recent years has actually required minimal increase in operating expenses. This has led to, as I mentioned before, a declining cost of doing business ratio, which, notwithstanding we're a growth business, we're continuing to target further reductions in that ratio. In regard to operating expenses, As we continue to expand our geographical reach across Australia, there's additional fixed costs which are incurred when we enter these markets that can't be serviced from an existing hub. So these costs usually include things like rental expenses, marketing expenses, and state management expenses, which are all clearly considered part of a geographic market entry strategy. While some markets like the Sunshine Coast are a greenfield opportunity, leaning on our existing infrastructure, such as our Queensland State Manager, who's based in Brisbane. Geographical regions that are further away from our existing hubs can require a different strategy. A good example is right here in Launceston with the Bushby acquisition, where a buy strategy was determined the most effective way to enter this market due to the Tasmanian local nature and tight-knit community. The acquisition of this business allows the brand to be at immediate scale, and that supports the infrastructure costs in a profitable way, and then allows us to build into neighbouring communities such as Devonport and then onto Hobart in a greenfield way. Slide 13 shows that the company is in a strong financial position. The chart on the left-hand side shows the progress that we've made on balance sheet improvement, along with our solid operating cash generation, which has resulted in the continued movement toward and beyond net cash positive. Based on our $8.2 million in cash at 30th of June and the $5 million Macquarie Bank loan, the business was in a net cash position of $3.2 million at year end. We've deployed some of this cash in the Bushby acquisition in July, and we've got the intention to rebuild back to a net cash position. On the right-hand side of this slide, we have a table that shows the key highlights from our balance sheet. And this is important to note. In our industry, the value of organically grown property management portfolios isn't actually recorded on the balance sheet. Our property management and mortgage book has a combined value of $22.8 million. However, only $10.1 million of this value is recorded in our balance sheet, leaving an asset value of $12.7 million that's off balance sheet. The table on the right-hand side adds this value to our statutory net assets, as they both represent value owned by shareholders, and that totals $29.1 million. Having gone through our business and its financial performance, I think it's useful to take a brief look at the operating environment for the industry. So we love our industry, and we love our industry because it underpins Australia's wealth, and it represents around about 57% of household wealth in Australia. As at the 30th of June 2022, the value of Australian residential real estate was $9.95 trillion, the biggest industry in Australia. It was nearly 4 times the value of the entire Australian listed stocks and about 3 times the size of the entire Australian superannuation industry. Interestingly, when we calculate the size of the annual commissions that are paid during a year for the sale of residential real estate, the annual commission pie is a staggering $7.8 billion. That's the total value of all commissions paid on the sale of residential real estate in Australia in the last financial year. Now, we've had a pretty good year in the last 12 months with strong growth, as you've seen, and we've grown our commission to $102.5 million, up from $80.7 million in the previous financial year. But at this level of $102.5 million, we only represent just above 1% of what is a highly, highly fragmented market. We see that as a key opportunity for us in coming periods. From our assessment, we've calculated that we've sold a property in around 34% of the addressable market in Australia during the last 12 months. This shows, we believe, the potential reach of our current infrastructure to that 34%, but it also highlights that we've got many further markets to tap into as we grow our national market share. Our strategy is to build depth in the existing markets, but also to grow into those additional markets. On slide 16, This shows that the addressable market is expanding each year. And you'll see here, there's about 17,000 new dwellings that are approved each month in Australia. This resulted in 197,000 dwelling approvals across the 2022 financial year. After the large growth in houses that followed the government home builder scheme, the housing market in coral on the graph has trended back toward decade average. However, interestingly, you'll see that the apartment construction, the chart depicted by the black line, is tracking below its decade average. And that, combined with the greatest gap ever between apartment and housing prices, we believe positions the apartment market and the associated investor market very well in the medium term. The National Housing Finance and Investment Corporation has stated that this level of dwelling approvals is the bare minimum needed to keep up with the expected population growth. With their prediction that overseas migration will recover and recover strongly over the next decade, the need for expected housing demand will outpace new housing supply by a cumulative 163,000 dwellings by 2023. Each new dwelling that's approved eventually finds its way to be a home for somebody. However, it also increases the total 10.2 million dwellings in Australia and ultimately increases the addressable annual commission pool for residential real estate sales. I'm just going to take a quick drink of water. Slide 17. This shows you how the industry volumes changed in FY22, and you'll see that there's an incredible divergence between the different metropolitan cities in Australia for that year in terms of volumes. Across Australia, down to the bottom left of this chart, there were 3.2% more dwelling sales in FY22 than FY21, 3.2% increase. There was stronger growth in the capital cities markets as they re-established themselves post-COVID, and slightly lower volumes in the regional markets, which had a very strong FY21 as people were moving away from the capital cities. Across the country, as I mentioned before, there were variances in market performance. Sydney was the first state where volumes and prices started to grow, and across FY22, it saw a reduction in volumes of 9.4%. States that had less favourable restrictions or started their journey later had a stronger FY22 in terms of volume growth. And that to us underpins the importance and the benefit of being diversified across Australia, as the property clock in each state works differently and allows us to balance our national resources. Importantly, our 15% increase in market volumes outperformed the market at a national level, as well as outperformance against the market in our key markets. Slide 18 deals with the rental market and the growth of rents across Australia as the demand for housing continues to outstrip supply and wage increases start to flow through the economy. There's been significant growth in rents across the country. Both houses and apartment rents are growing. And in contrast to the sales volumes, rental growth in regional markets is outpacing that seen in the combined capital cities. At a national level, the housing category forms the largest category in the CPI basket of goods. Rents is the second largest individual category in the CPI basket of goods at a 6.23% weighting. That's second only behind new dwelling purchases at 8.67% weighting. Among many other factors, the combined growth in rents continues to underpin the rising inflation numbers that we've seen. Over to slide 19, and this data deals with the details of the percentage of new loans that are made to investors. While investor participation has grown from recent year lows, it's recovered to the 10-year average, which represents now about 35% of all lending. With the really hot rental market and record low vacancies and strong rental growth, this growth in investor loans is important as these new investor purchases eventually enter the rental pool and provide some more supply to moderate some of these factors. Moving briefly now to our strategic objectives and the outlook for the coming financial year. And slide 21 details some of our strategic objectives for the 2023 financial year that our management team are working through to continue to grow our reach across the Australian real estate market. Consistent with our record-breaking number of agent recruits in the 22 financial year, the continued attraction of agents and growth in agent numbers across existing geographic regions, as well as further expansion across new regions, will facilitate our further business growth. We're also focused on enhancements of our adjacency offerings to our customers and our agents. An additional priority, of course, is the further development of a multi-brand strategy and building upon the foundations of our second brand, SLP, that currently operates in the Perth and WA market. Finally, we see the need to continue to invest in our agents through training initiatives, sales management support, and to ensure that they're best positioned to capitalise on what is a changing market, but also importantly, using technology in a more productive way. Our proprietary technology not only enhances the agent experience and also, importantly, our cost of doing business efficiencies, but also allows the business to begin to leverage the large volumes of data to deliver customer insights to our agents. Turning now to slide 22, and this shows our outlook for the coming period. And really, until there's certainty around interest rates, we expect transaction volumes to remain quite volatile at the national level. We think that states with a lower median price point will outperform higher median price states in terms of transaction volumes. In terms of price movements, we've revised our calendar 2022 national price growth to be a -4% to -8% for the calendar year. Now, for the first 7 months of the year, up to the end of July, the reduction was 1%. And that means to get to -4 to -8, we expect from the end of July more rapid declines in the second half of the calendar year. As the market continues to tighten up, we expect vendors to look to experienced agents who've got a track record in these changing market conditions. We believe this will result in a reduction in the number of real estate agents in Australia. We're confident, though, that these market conditions will work to our advantage, not only to help to attract new agents to our business and grow our agent numbers, but also to help many of our existing agents to gain market share at their local suburb level. Furthermore, to these challenging market conditions, we believe there'll be a continued theme of market consolidation, of smaller independents and franchisees looking to simplify their businesses. There's a strong correlation between housing volumes and consumer sentiment. Based on the Westpac Melbourne Institute of Consumer Sentiment is on par with the lows of the COVID and GFC levels, but still just above the lows of during the late 80s and 90s recession. We believe that sentiment will improve in the short to medium term as soon as the rate of interest rate increases slows and rates approach and then reach their terminal value. Then, as we expect in early to mid 2023, we'll turn to some small interest rate cuts. Upon that tipping point of the change in the rate of increases, we believe that will lead to an improvement in sentiment and greater transaction volumes in some of the states which have seen a pullback. That concludes the extent of our presentation this morning and the slide deck that was lodged with the ASX. I'd like to thank you for your time today, and I hope that this has helped give you a little more understanding about our business, how we differentiate, and also the successful performance that we've had in the last financial year. And I'm really happy now to take questions from participants from a few moments that I mentioned before. To submit a question, please use the chat function in the Zoom webinar. I'll now pause for a moment to collate any questions.
Thanks, Geoff. A great presentation and overview of the full year results for the agency. We do have a lot of questions that have come through, so I'm going to try and group them as best as I can into obvious topics. So let's start off with Launceston. You're down there at the moment. Why the move into Launceston rather than an entry into Hobart as a first stage?
Yeah, so thank you for the question. When we're looking at moving into a new market, obviously the thematics of that market are important, and there are various drivers that we look at, but the most important, not only the residential market that we're interested in, that needs to be strong, but it's about the people that you're going into business with. It is a people business. And so whilst we were looking to enter Tasmania, we were really equivocal about whether it was north or south. And the opportunity that came before us to align with this group at Bushby that has a very, very strong and positive legacy. They've been in business for just on 108 years. They probably have one of the greatest positive legacies, certainly in Tasmania, if not the Australian industry. That's the reason we came to Launceston first. There's a very strong thematic of the whole of Tasmania, as most people will be aware. They've experienced very, very strong demand, and there's a tremendous synergy and interest between, as they call us, mainlanders looking to come to Tasmania. And we think that there's great benefits. Being a truly national business, tremendous benefits, not only for our agents in doing business and generating referrals between the 2, 3, 5, 6 different states, but for their customers, and to increase the buyer reach for the people in Tasmania to the eastern and western seaboards is a really powerful thing for the people in the respective communities. So that's why we chose it. It was the quality of target, and I guess the cultural values that we share as well. These are really important things apart from just metrics on a spreadsheet.
Now, looking, I suppose, a little bit broader to recruitment, how has recruitment been progressing? It's obviously been a busy time up until the year end. How's recruitment been looking post year end? But also, there seems to be a trend that you're attracting bigger writers and even business owners as part of recruitment, as seen here with Bushby. So how's recruitment going, and what's the attraction for the big writers and also the business owners who seem to be moving across?
Yeah, I'm reticent to give forecasts, of course, but recruitment has continued to be very successful for the reasons that we set forth in the preceding presentation. So we're continuing to have great success there. An interesting evolution there in some of the markets is indeed smaller principals or franchisees that really grew their businesses, and their salespeople that all of a sudden had businesses to run. And as the market has tightened, and I alluded to that before, they just want to return to the simplicity of listing and selling property and servicing their clients. So we're seeing a large thematic of people looking at what the independent or indeed the franchise group offers and saying it would be a whole lot easier just to sell my rent roll to you and to come across and list and sell with the agency. So we're seeing more and more of that. And to that extent, we welcome a tougher market and a changing market. And so we are starting to see more and more. And that's the comment I made about consolidation as well. It's an enormously fragmented industry, and we see an opportunity for consolidation, and that gives us economies of scale, efficiencies, and it's beneficial to our agents as well because they've got more people to do business with and share. And I mentioned also about the large data that we generate, and we're in the process of using technology to make sure that we're accessing that data in a way that's beneficial to generate leads and future business for our agents.
This might be a tricky one because it's quite specific. On the comment regarding sales in 34% of the addressable $7.6 billion market, can you tell me a bit more about that, and perhaps how many suburbs does it represent?
Yeah, so that represents by number approximately 850 suburbs that we've sold properties in. And of course, there's more suburbs than that, being 34% of total suburbs in Australia, but it's the value. So those 850 suburbs represent 34% of the value of residential sales in the Australian market. And so that's where we've sold property, which is a pretty impressive number. And as I said in the presentation, it demonstrates two things. One, that we've actually got the infrastructure in place to properly mine and penetrate almost a third, a little bit more than a third of Australia's entire market. But also on the flip side, there's another, and we won't go to the full 66%. There's markets that we wouldn't necessarily go to, but there are extensive new markets for us to move into as well. And that's part of our strategy to do both of those things.
And can you communicate a bit more about the depreciation and amortization charge recorded and the comment that property management value is held off balance sheet?
Yeah, this is a special one for those accountants out there. And for those non-accountants, please excuse this. Unfortunately, the accounting standards require us to, I'll start from the beginning, try and keep it short. When you acquire a rent roll, say for $10 million, that's a number of properties that are under management. Notwithstanding that we then look to grow that, we're required under the accounting standards to write that off. And notwithstanding the property management often grows, we're required to take an accounting charge, non-cash charge for that. And so it probably unfairly is booked as an expense below the EBITDA line for that amortization. Yeah, it's a difficult one because as we grow our property management book organically, we don't get to write the value of it up on the flip side. So that's a basic layman's explanation of what happens with that charge. It's non-cash. It looks as if it's a negative, but it's just an accounting standard that we must comply with.
And maybe another accounting question while we're on a roll. The cost of doing business, what does that number relate to, and why is it so important to see it trending down?
So I mentioned also during the presentation, I said, notwithstanding we are a growth company, and we are a growth company, with just on 1% of a $7.6 billion commission pie that we're competing for. Make no bones about it, we are looking to grow our market share significantly in coming years. Cost of doing business recognises that we want to be accountable for our stakeholders in ensuring that we grow our business in an economically responsible fashion. And so while we are looking to grow as quickly and appropriately as possible, we're trying to do it in a cost-efficient manner and deliver increasing earnings to our stakeholders. Now, you've always got to balance that, but we think that that measure is a nice one for people outside the business or shareholders to have a look at how we're going in terms of controlling costs while we're looking to increase our revenue. And it's represented by operating costs over total revenue.
We are getting a lot of questions coming in thick and fast, so I'll try and get through as many as we can. This is a comment and a question. Really enjoyed the agency's acquisitive mindset during full year 2022. Will the group look to continue blending organic growth with external opportunities?
Absolutely. We see, organic growth is the recruitment of agents, and at 1%, and it's a relatively new business. We're only just on 5 years old, and so a lot of people say, the agency, which agency? And so we're not that well known as yet. Notwithstanding that, we do generate a significant amount of transactions at about $5.9 billion in homes sold. And so we are looking to grow organically, and we're starting to generate increasing rates of natural agent inquiry as they see our growing success. They see the culture of the organisation. They see the benefits that will accrue to them as professional salespeople inside our business. But we'll also take the opportunity for M&A where the opportunity arises. And case in point, as I mentioned, sitting right here in Launceston, that was just a wonderful opportunity to acquire a business with a great heritage. So yes, we will look to do more M&A, particularly in an environment that is serving up some opportunities. But of course, we need to weigh that against allocation of capital. And we're a little bit reticent to issue more paper in doing those things. So, it's a balancing act of M&A and organic, but we are seeing increasing opportunities.
And just on that, is acquisitions more likely to occur in different stages of the cycle? And one of the points here is it too early in the down cycle to see more acquisitions coming to the fore? And the other point that this question, or the person asking this question made is, aren't your own shares the most attractive acquisition at the moment?
Personal view. I think our own shares are an attractive acquisition. Again, my role is to balance the competing forces about where we allocate our capital. And whilst there are strong arguments when we're generating strong and growing cash flow to acquiring our own stock, we've got to balance that against the ROI that we can generate from making an acquisition. Just case in point, this one here. So being a relatively new business, relatively small business, capital is important to us. Capital management is important to us. But to the person that asked that question, every single day I make that assessment about the best use of our capital. So please understand, and happy for you to contact me directly, that we do assess that every day, week, month of the year in terms of the best deployment of our cash.
I suppose some of this is now starting to look a little bit forward. And not wanting you to make forecasts or projections. As you grow agent numbers and GCI, how have you fixed, and therefore do your fixed costs increase, and what effect do you think that will have on EBITDA and NPAT?
Yeah, again, reticent to provide any guidance for a number of reasons. I did make some comments during the presentation about reaching a critical scale, and we've done that. Sometimes we get some criticism about being overweight in terms of cost. But, we've built this business, mark my words, not to be generating $105 million in commission income, and certainly not to be, a sub $50 million market cap business. And so we've made that investment upfront to get the appropriate infrastructure, scale, management, leadership team in place to exploit what we think is a market that's going to serve up very strong, I was going to say enormous opportunities. I spoke about the $7.6 billion commission pie, and we've had a good year going from 82 million to 105. But that's the opportunity before us to participate at a significantly greater level than that. And we think we have a compelling business offering. I'd like to think that our agent team believe in that as well. The numbers of new agents joining us seem to suggest that. It's a contemporary business model. It's different to the old-fashioned way of franchises distributing real estate services. And we think it represents the thematic of the way that business will continue to be done into the future. We think it's a more appropriate manner of business for the current environment. So, yeah, we incur fixed costs to a point. We're starting to generate economies of scale. And yes, as we grow that gross commission income and revenue, we would think, hence the comments about reducing cost of doing business and therefore attendant margins. Now, we will go through different market cycles. We're insulated somewhat from that because we've conducted the strategy of being truly national. And I think one of those slides that I showed, the great variance between the volume change in Sydney versus, say, the volume change in Perth. We really love having exposure to the whole national marketplace because they move in different ways at different times. Long-winded answer, but yeah, we have invested for growth and we're pretty excited about the growth opportunities before us.
Now, I'm assuming this question relates specifically to the property under management business. So properties under management have fallen approximately 135 in the past 15 months, and revenues have therefore fallen as well. What's the strategy to improve that part of the business? If it has a value pre-Bushby of around $19 million, have you considered just selling it?
Look, we love our property management business, and true, we did, along with many other companies, have a slight reduction in the number of properties under management, excluding the ones that we've acquired. And we do look to grow that portfolio organically, as I mentioned. What we've been through is a period where, during the financial year, where it made sense for investors to be selling their properties. If you think back to the peak in some of the markets, which might have been around about October, we saw large numbers of investors say, gosh, now might be a good time to cash in and sell. Now, the purchasers of those properties were not investors, they were owner-occupiers. And so you see a natural reduction in the properties under management due to that. What we're seeing now, and the dynamics that I explained on one of the slides about the rental market, we're seeing a really strong circa 9 to 10% annual increase in rents. And so we're starting to see investors come back into the market, also demonstrated by the slides that we showed on the investor participation being 35% of all loan applications. And so we're starting to see a strong thematic there back toward investment properties. You'll also note the comments I made about the largest ever discrepancy between house prices and apartment prices and the attendant future potential shortage due to the approval rates. And so those factors, we believe, augur well for investment properties and give us a strong opportunity to then grow that property management portfolio organically, and then it'll be supplemented by acquisitions that we think make sense.
Okay, final question. We have got through all of the questions, so thanks everyone for sending them in, and Geoff, thanks for answering them. Final question relates to the next 12 to 18 months. What strategies will the agency implement to combat declining house prices, falling stock levels, lower clearance rates?
So I mentioned before about what we think will happen in terms of the market going forward. The broad assumption that falling stock levels, falling prices, and I can't recall the other one.
Clearance rates.
The clearance rates, yeah. Well, interestingly, across some of the major cities, certainly Eastern Seaboard, Western Seaboard don't do so many auctions. In the last 2 weeks, we've seen actually a small uptick in the clearance rate. I guess my overall answer there is what is now is not necessarily the case for the future. I talked about consumer sentiment at the moment. It's a strange thing. Consumers out there at the moment, sentiment is at not an all-time low, but it's pretty low because you're seeing 50 basis point increases month on month by the RBA. Now, we all know it's not going to go on forever, but there's an underlying thought and feeling that, gosh, where does it end? At the point where a 50 basis point increase becomes a 25 basis point increase. Now, I'm not suggesting that's next month, which is next week, I think. But if not next month, highly likely the following month where 50 becomes 25. At that point, consumers think, gosh, there is an end in sight, and you get a rapid change in sentiment. When sentiment changes, vendors all of a sudden change their view. Right now, buyers are sitting on their hands and saying, well, why would I buy now? Because I think that prices are going to be lower in the future. So I'll just wait. Why would a vendor list their property? Because they know that the buyers are sitting there saying, why would you buy now? And so you get kind of a freezing of the market, low listing rates. As soon as that sentiment changes, and it happens quickly, and the media jumps on board, then you get a change. And we would expect that sometime in the next 6 to 8, possibly maximum 12 weeks, we'll see a change in sentiment and therefore transaction volumes will change. And that was the purpose of that slide. So I guess overall, what is now will not always be. Humans tend to over or underreact to things. And so that's what we see. Now, if conditions didn't improve, my previous comments during the presentation also hold. We think we go better in a tough market. We think we offer services, environment, support, performance better than the vast majority of the industry, and that's driving agent inquiry. So if it remains tough between now and the end of the calendar year, we think we'll start to see increasing number of agents inquire and talk about joining our business. So, we gain market share.
Thanks, Geoff. That brings us to the end of our questions. A very detailed and thorough presentation off the back of a very strong full year 2022, a clear outlook ahead for the agency, both from an operational and a financial point of view. Exciting times ahead. We'll keep watching. Thanks everyone for tuning in, and we look forward to speaking to you again soon.
Thank you very much, and thank you everybody for spending some time with us.